Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Stocks struggle to start 2024. Well, stocks stumbled a bit in the first few trading days of 2024, and the biggest losers so far this year were the biggest winners of 2023. The tech-heavy NASDAQ was down around 3% this week, which was led by a decline of more than 5% for Apple, versus just over a 1% decline for the S&P 500 overall. Now, this actually makes a lot of sense. Investors were reluctant to sell their winners at the end of 2023, realizing capital gains that would have to be paid in April. By waiting until January, they pushed out the tax bill on any realized gains until April of 2025. So the question going forward is whether or not this is purely some technical selling and modest rebalancing and repositioning to start the new year, trimming some winners, adding to some underperformers, or is there a more durable market shift that's beginning to take place? We do see the potential for some of the defensive areas of the market to continue to outperform given some softening economic data and the potential for further downside in earnings revisions for the next couple of quarters. So we'll be keeping a close eye on the evolving economic and corporate landscape as we look for opportunities to get more aggressive on any meaningful market pullbacks going forward. For this week's featured insight, be a contrarian. There's a lot of misunderstanding about what it means to be a contrarian when it comes to investing. Most people believe that being a contrarian means that you fight the prevailing trend. So if stocks are trending lower, you buy them expecting them to reverse. However, a much more sound investing strategy involves staying with a trend when the sentiment among market participants or the prevailing narrative runs counter to that trend. There's currently a very strong consensus narrative that interest rates are likely to head lower this year. And indeed, the Fed may cut the Fed funds rate at least a couple of times this year. Nevertheless, longer-term interest rates could continue the trend higher they started back in 2020. The market is not likely all that prepared for this possibility. So being a contrarian would mean being prepared for the risk that longer-term interest rates go significantly higher. Looking ahead, another earnings season looms. At the beginning of October, aggregate S&P 500 earnings for the fourth quarter were expected to eke out a growth rate versus the prior fourth quarter of a little more than 0.5%. Currently, they're expected to decline by more than 3%. So earnings estimates for the fourth quarter have been falling over the last few months. Nevertheless, analysts always give companies a low bar to leap over, so it's more likely that they'll actually be flat to slightly higher. What's really important, though, as I've said many times before, is what happens to estimates for the current first quarter and second quarter of this year, to ultimately be reported in April and July, respectively. But currently, the first quarter is expected to be flat growth year over year, while the second quarter is expected to see 6% growth. Now, any hints in company reports that these estimates are too high could inject some serious volatility back into the stock market, as the current soft landing narrative would ultimately be called into question. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.